This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk, and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Well, Luke Winchester, thanks very much for making your debut on Talk Your Book. Really excited to sit down and chat with you. I've thought before we get into your stock pick, if you could tell us a little bit about Merewether Capital, how that came about, and I guess to touch on the obvious, what a bloody challenging time to launch a fund that you did. So tell us a bit about Merewether.
Yeah, so Merewether Capital, we're a small micro cap fund. As you said, we launched back in November. I like to tell people it was about a week after the peak in the NASDAQ. So at the time, didn't realise how tough it was going to be, but here we are. Pure micro cap fund. We launched with about 5 mil under management. With the current markets, we're sitting a bit over 4 today, but hopefully survive the worst of that volatility coming out the other side now. But it's been a trial by fire, but a good thing. A lot of people said to me when I launched, attracting a good investor base is probably the most important thing you can do. I really tried to do that. I didn't think we'd be tested so early, but so far, the support from the investors has been fantastic. Some have topped up into the weakness, but even beyond that, just a lot sort of, reaching out, making sure that we're doing well, sticking to the process. As we all know, we go through these periods and as I've been saying to people, that creates the opportunities that come out the other side. So still confident we can do really well. It's probably good to get out of the way when we're small and we come out the other side and grow.
And you sort of had a bit of fame in the microcap world before launching the fund. Certainly, I think you were the best performer on Strawman, which for those who don't know is sort of a website for stock pickers that sort of share their ideas and investment process. And it's a pretty small community, the microcap landscape. Is that sort of helped build a fund, the fact that I guess you'd already built up a level of trust, with a follower base before you actually decided to take the plunge and take on other people's capital?
I think so. So prior to launching Merewether, I was working professionally industry, but Strawman was my personal investing. So I was managing that on the side. I was able to do that where I was, was lucky enough to come to Strawman at a good time in the markets, and a few of the stocks that I liked and did some research did quite well. So put me on the radar of a few people. I'm sure that obviously helps to have that sort of, public image in the market or support from people. And so when I launched Merewether with the help of Harley Grosser and what he's doing at ARC, I think it was certainly a consideration that, I wasn't someone coming out of a large fund management business, broking house or investment bank, but I had something we can build with, particularly in that micro cap space, like you said, where that community is very, very small and you certainly get to know one another.
And it's a really underrepresented space, particularly by fund managers, the microcap area, which means there's huge opportunities, but the reason it's underexplored is because the fees tap out, because your fund can only grow to a certain amount. What sort of level do you think your fund can grow to before you'll start to tap out and be challenging to hit the opportunities?
It's such a good point. I think you're right. I think that is, liquidity is the biggest constraint for people. So you have to manage that yourself, through your positions and through your fund size. So my mandate for Merewether Capital, I say micro cap sort of sub 200-300 mil. I think you can run a fund sort of 40-50 mil up to that level, and a few people I know in the space have sort of capped themselves around that, maybe a soft cap a little bit before and a hard cap later on. Because you're right, you've seen so many people start in sort of micros and smalls, and as their funds get bigger and they're forced up into that liquidity into the mid caps and large caps, they often struggle to perform because you've found your niche in micro caps or small caps. And of course, it's just much more competitive at the larger end of the market. So it's a balance that you have to be aware of. You have to, manage that and be clear with your investors about with your investors and yourself, I guess, about the spaces where you're playing and where you think your edge is.
And what stock did you want to talk about today?
Well, talk about global health. So to me, classic micro cap, 20 mil market cap. A lot of people would shudder at that sort of number. I talk to a lot of people in the industry who they won't even look at stocks that are under certain market caps because they know liquidity is going to be so poor. But that brings the opportunities. And I just like to rattle off some of the names to people of stocks that have been micro caps in the past. I remember Altium when it was a 20 mil market cap, Dicker Data, Objective Corp. These are some of the success stories that started off as micro caps. So I'm here trying to find the next one. Global Health has some of those characteristics. So I thought we'd have a chat about it today.
And what's the top-down view of the business?
Yeah, so medical software, as the name sort of implies. It's the example of a stock that I actually like. So it's been listed for quite a long time. The business has been around since the 90s and even listed now for a decade or two. So that in itself brings some baggage. A lot of people know the stock, have owned it before, maybe you've ridden it up and down, and you get some stigmas attached to it and whatnot. And so sometimes coming at it later on with a fresh set of eyes or where you think there might be something changing in the business, I think brings some wonderful opportunities. So Global Health, I think, at a time like that. So medical software focuses on electronic medical records and patient administration systems, so the two core softwares. There's some modules around that, some sort of value-added stuff around secure messaging, teleconference abilities now, which obviously was a nice boost through COVID. But have really got that core in that sort of patient administration system. Really focused on that niche of smaller providers in community health. Community health providers, small hospitals. They've found a nice little niche in mental health providers as well. They try not to go and compete with a large hospital group, so you won't see a Ramsay Healthcare running a Global Health software.
Because they'll build their own, or?
Some build their own. Most use is actually, their biggest peers are large players over in the US. So for those guys, multi-billion-dollar market caps, it doesn't make sense for them to come down into the small niches where Global Health plays, particularly because the software not only is highly customised, but has to be highly adaptable. The medical funding system changes quite rapidly, not just within governments, but obviously as governments change. NDIS was the latest big change made to that system. So you need software that's able to quickly adapt, and so that's where knowing your niche and having the right focus, I think, has been the right decision for Global Health.
And what are sort of the different divisions that the company currently is targeting?
So one of the main reasons I really like this business right now is they brought in a new CEO about a year ago. So Michael Davies, he brings enterprise experience from Macquarie Telecom. So when I saw that announcement, my eyes sort of opened wide. You don't often see, Chief Revenue Officer at Macquarie Telecom, what theoretically looks like a step back to this tiny Aussie micro cap. Talking to him, he sees the opportunity to be a CEO and take this business and really drive it. So the first big change he made was to really focus that business. I think he saw a business that was doing a lot of different things, doing them well, but really spread across, different types of software and modules, different customers, different geographies. And as I said, he's really refocused it back to that community health, small private hospitals, and mental health. Even from the software suite, really focus it back to that core, what they call master care, patient administration, and electronic medical health records. So still doing the other software, and will over time bring that into the master care system. But I think he looked at the software and sort of said it was a bit, it had different brandings, different target markets, different approaches to market, and so trying to focus back to what they do best. So I think he's now done that. He's put some things in place around really bringing a sales engine in place and some enterprise experience to the business. And that refocus, well capitalised, he's now looking to really drive penetration into those core three markets.
And they've just hired an Asian, a CEO for the Asia geography. What's that strategy going to be like? Do you see them just looking to grow organically throughout Asia? I know they've earmarked a couple of countries they're going to target, or do you think they'll try and buy a masthead in each country and build from there?
Well, to be honest, I think they're sort of playing it a little by ear. They've highlighted the potential for M&A. They've highlighted the potential for organic growth themselves. The other thing they've highlighted, probably the easiest way to expand is business-to-business relationships. So finding businesses over there that already have the customer penetration and looking to, whether that be a reseller agreement or some sort of partnership agreement, bring their software into those regions. I think speaking to the company, the core patient administration and EMR will be a bit more difficult And where they're seeing probably the best traction at first would be some of those other modules, so around the secure messaging, the teleconference abilities, and another segment they've got is called Life Card, which is like a personal health digital diary sort of thing. So seeing something like that to sort of penetrate that digital health into the Asian region, where probably doesn't have as much penetration as what we have here in Australia. So long story short, look, I think they see the potential of the region like a lot of businesses do. How you attack it, it's such a big pie. There's a lot of different ways to go about it. So I think they're sort of sitting back and testing these different things. The appointment yesterday of a CEO focus there, I think, makes a lot of sense because you've got Michael completely focused on the Australian division. But I sort of sit back and wait to see how that plays out. Where I do have a lot of faith, speaking to Michael multiple times, he's very aware of capital allocation and how best to think about it. And so I think, like everyone else, he sees that opportunity, and I trust that he'll be prudent about how he goes about it.
And it's one of those businesses which you see a little bit where top line revenue numbers look just okay. But if you dig a bit deeper, their legacy revenue business is dropping quite rapidly, and their recurring revenue is growing. Looks like 10 to 12% a year on average, which is pretty strong. What are the professional services? What is the legacy business that's effectively being wound down? And do you think perhaps those top line numbers don't give a clear view of just perhaps how strong the revenue growth has been?
I think that's right. So the core business has always been the same. It's just how you bring that software to market. So they've made the transition a lot of other businesses have done, which is switching from that legacy license base to software as a service. So you've seen that transition play out over the last few years, and like a lot of businesses, that reported revenue number gets a bit lumpy because that front loading of revenue now gets stretched out over many periods. The other impact that you highlight there is professional services. That's basically like implementation and support revenue.
Okay.
So very lumpy around big contracts with larger customers, and this is software that it's quite sticky once you're in there, not only in the government space but also in that medical space. You integrate quite deeply with the systems that these businesses run, particularly like a patient administration system. So, they can be 6, 9, 12 months integrations that Global Health will sit down with customers and go through. So that drives that professional services. Obviously, revenue's revenue, it's cash in the door, it's nice. But I think you're right. The focus on the quality revenue is really that recurring revenue, which has grown strongly. This year it was around, I think you're right, 12%. The business has got an internal target of 25% over the next few years. And they've announced some contracts, particularly in the last about six odd weeks, I think 3 or 4 contracts. You tally up the recurring revenue in those, and they're starting to get towards that 25% number over the next couple of years. So that's where I'm getting a lot of certainty that recurring revenue growth should continue to be pretty solid.
And historically, not quite cash flow positive yet, but pretty close. When do you think they'll be sustainably cash flow positive business?
Well, historically they have been cash flow positive. So FY20 they
just last year. So.
Yeah, they did about $1 million EBITDA. So when Michael stepped into the business, he was very honest with the market and said, look, I'm going to put some costs into the business, flesh out the C-suite, put some sales staff on. So before he came on, they had 1 sales BDM, and I think they've now got 4 or 5. And just put some process in place to take this from what was basically a small family-run business to his enterprise background kicking in. So they've swung to probably about a $1.5 million EBITDA loss this year. Some of that is sticky costs that will stay there. Some development that was being brought forward. But that revenue growth will kick in. So I suspect sort of FY23 they'll be creeping back towards that break even, and then you'll probably see the real leverage kick in FY24. So it's probably not the right stock for today's market. It's not spitting out a ton of cash right now. But it doesn't take a great deal of imagination to see it coming, because they've announced these contracts in the last 6 odd weeks and are pretty confident of winning some more. So, you have to be a bit patient because, like I said, long implementation cycles, 6-9 months. But as those implementation cycles come in, that recurring revenue then hits the base and starts to really tick up. That cost base should stay, pretty flat from here. You'll get some, general OPEX, but the leverage should really kick in after sort of FY21 when Michael came in and sort of tacked on just a bit of extra cost to flesh out the business.
And balance sheet looks strong for a company this size. Maybe talk us through what their balance sheet's like, and they've mentioned M&A. What sort of size businesses you reckon they could take a swing at with the level of cash and potential debt they'd have available?
Yeah, so they raised some capital last year, so it was a good time in markets to do it. Gets them I think they've got about 6 odd mil cash on the balance sheet today, which is a good number relative to the size of their business. They've flagged some M&A that could be in the Southeast Asia, as you were talking about before. Talking to Michael, he's also flagged there's a few opportunities domestically in Australia. So some examples of that would be these small community health regions, scattered around, usually rural areas, of course, where some legacy software was developed 15, 20 years ago, maybe by a small consulting firm or something like that. And he's got the opportunity to come in, acquire it very, very cheaply and essentially pick up a customer
really
base.
Buy customers, if you like.
You buy the customers.
The software.
Yeah, and then you roll out the Mastercare software over time. So there's a few of them. It's just about finding them and paying the right price. I think he's mindful of where global health's valuation sits today versus sort of what you'd have to pay for something. But yes, stuff like that could come along. Southeast Asia. I think M&A. It's certainly a possibility. But I think the organic growth is the focus right now. So, you keep your eyes open, but you're also mainly focused on the prize.
And you mentioned that they're a sticky customer base once they've been won. Perhaps the sales timeline's pretty lengthy. But what sort of numbers are their churn? Do you know?
Yeah, well, look, they don't report churn. I've asked Michael about that. I think he said to me that they hadn't lost a customer for many years.
Yeah, wow.
It's just the nature of that software. These organisations, the sales implementation so long that they're unlikely to change, and it sits so deeply in what they do. It's very difficult to then go and change afterwards anyway.
And health is a business where cutting costs as much as you can. It's less about that and more about safety and the fact that something's working. Is that fair?
That's right. Yeah. So it's, medical software players on the ASX. There's a reason why the market really likes them. They are generally much more sticky than enterprise software, where yes, it's very cutthroat and you can often interchangeability to other softwares not too difficult, and you can often just compete on price. Medical software much stickier. But that comes with the catch-22 of much longer sales cycles, much longer implementation. So, talking to Michael, some of the contracts they've announced recently, they first spoke to these customers early last year. It's a long time from that first coffee to when the contract's signed, and then also, from market's point of view, a long time before implementation and cash hits the door. So, it's one for patient investors, but the confidence I get from the stickiness of those customers, that once they're in there, once they're integrated, they'll be there for a long time, and that recurring revenue will keep just ticking up.
And they've spoken about in-home care being a focus going forward, and you can see the governments have such a huge rush to get people out of hospitals and back into their homes, and even with elderly people that are hesitant to go into aged care. Is that a sector you can see really growing strongly over the coming years?
Well, like I said, they had a module before COVID that allowed for telehealth at the smaller level. So COVID hits, and there was an opportunity to really develop that module and on-sell it strongly to customers. I think the area as well they're focused on with that sort of market is in the mental health space. I think a lot more government funding's coming into mental health, and they're quite well positioned. The marquee contract they've got there is actually with the entire state of WA. The mental health institutions there to have their software, and it's quite different to physical health, in a sense where physical health is very much about treat a problem, get the patient out the door as quick as possible, whereas mental health is much more about ongoing treatment, and as you said, how the treatment goes from not just the hospital institution but also back to the home and ongoing. So having dedicated software for that, I think, is very interesting. They've got that marquee contract with WA, and I think they're confident of landing, other states, as particularly the stigma's not the right word, but maybe the focus on mental health, really gets increased, and some funding comes strongly into the space. And
companies, small software companies, one of the hard things to work out is if the software is actually defendable, or if it's something where in 5 years' time, Google will be doing it for free, or another tech company. But I think you touched on it already, but the funding part of medical professionals is really complex, whether it's private health insurance or Medicare or the NDIS, and obviously Google's not going to spend any time trying to overcome that problem. Is that niche aspect of this one of the parts that does make it defendable, and you can't see it just being a free-to-use bit of software that tacked on by a major tech company in years to come?
I think so, yeah. You're playing in a small niche, also a lot of regulation around that niche, and as you said, the funding is so complicated that it's software that needs to be highly adaptable, not just at a state level but a district level, because these institutions can get funding from dozens of different sources. It was the first question I asked Michael when I first spoke to him. So he came on as CEO. The business had just raised capital, so had a bit of cash in the bank. He'd made his intentions clear of what he wanted to do on the sales side of the business. The anecdote I think he provided at the time was they tendered for 2 contracts the year before and won both of them. And from his point of view at an enterprise level, that to him that means we're not tendering enough. We need to be tendering for more, so we need more boots on the ground, and they didn't even have a CRM software or anything like that. So that's where his focus was initially. But one of the first questions I asked was, the quality of the software, because to me, if this was a situation where you had a good piece of software in a nice niche, that had been around for quite a long time and a steady little moat, and someone with some really good experience was about to step into this business and just bring some real enterprise level processes and systems to it, I was really interested. Where I was a bit apprehensive was, is this a situation where he also needs to spend a couple of $1 million to get the software up to speed? And he was quite clear that the software was in a really good space. They were in the middle of the transition towards the software as a service. He did say he would accelerate that, so I think he brought that sort of timeline forward by 6-12 months. So he ramped up some of the development spend, but it was just to do what the business was already planning to do. It was certainly not to overhaul the software suite. From that point of view, I think the most he's really done is like I said, refocus the software. He'll rebrand it. He'll bring everything under that core Mastercare brand, which has a good foothold in the market. But really, the focus was a good piece of software in its niche, but probably has underinvested in itself as a business, and so the potential to invest in that, really drive it. He said it would take time. He said it would take about 12 months, and that's how it's played out in the last sort of 6 odd weeks. There's been a nice flurry of contracts, and I think that momentum, it is certainly a space where customers talk to each other. So you can win one contract and people see what other, what providers are using what software and what the feedback's like. So it doesn't surprise me that snowball has really started to accelerate, and the last contract, was actually the largest. So, I think starting to hit its straps, and that's why I'm getting a bit excited about the stock.
In the last quarterly, I think the numbers looked like it was about an 8 million annualised run rate and, like you said, a small loss. In 24 months, what do the full year numbers look like for it to be a success in your eyes?
So there's 2 ways to think about it. One's, as I was talking about before, from a recurring revenue point of view. In a couple of years, I think they should be pushing more than 10 mil recurring revenue, maybe even as high as sort of 11, 12. The professional services is the sort of swing factor to the bottom line numbers in particular. What actually gives me a little bit of optimism there is, as I said before, the last contract they won actually came with a pretty large slug of professional services, $1.2 million over the next couple of years. So that'll really boost that bottom line from that point of view. So I'm a little bit more optimistic they could be closer to that break-even number in FY23, and then I would think FY24 you're now swinging well and truly into profitability. Maybe just a small number at that time, but from an incremental point of view, I think you'll see that incremental revenue dropping down quite strongly to the profit line. And
outside of the growing revenue, what are the next milestones you could see them hitting that could lead to a re-rate?
I think just contracts, keep winning contracts. They've been small, as I said. I think that's why they've sort of gone a little bit under the radar of the market. They haven't been, a big contract that's $500 million a year. They've been sort of 100,000-200,000 ARR being tacked on by each one. But of course, like I said, there's been 5 or 6 over the last few weeks. So you start to add them all up, and the next thing you know, on my rough numbers, the business is tacked on sort of 800,000 to 900,000 ARR on a 6 mil base. So, good accretion coming in the next year or two as they implement these contracts. So I expect they'll probably stay small because they are in that niche where they're not going to win a Ramsay Healthcare or something that just sends the stock flying. But it's certainly one that can compound over the next few years, not just intrinsically itself, but hopefully the share price as well.
Beautiful, mate. It was a great place to finish, but mate, really appreciate you coming on the show and great to connect.
Thanks, mate.
Thanks, Luke. This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.